Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for joining us on Powerlines. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets come off their day's lows but fail to move into the green.
June wholesale prices comes in at a 4.5-year high. Petroleum products rises 8.1%.
The LIC board is expected to give an in-principle nod to the insurer increasing its stake in IDBI Bank at its meeting today.
Dr Reddy's is the top Nifty loser after it's barred from selling a generic version of opioid addiction treatment drug by a US federal court.
All right, conversations coming up on the show. Friday late evening, we heard that the trade deficit has risen to 5-year highs. We'll get Shagata Bhattacharya of Axis Bank in on that. And Eni Ansari of JSPL spoke to Bloomberg Quint on the implications of the enforcement directive's charge sheet against the company's chairman, Naveen Jindal.
But first, the markets. Neeraj is here as always with a closer look on how Monday is looking today.
Hey, IT is saving the day, Harsha. So that's honestly the trade that is shaping up, because Infosys is up about 3.5%. It's pulling up some of the other IT names, Wipro, Tech Mahindra, etc. All of them seem to be doing okay, and which is why that's the saving grace, because otherwise the cuts at the other end are fairly steep. Look at Pharma, for example. Dr Reddy is down about 8.5% on this piece of news, of course, and I'm sure you'll discuss it a bit later on in the show, but down about 9.5%, excuse me. It's worsened even further now. There are cuts in Sun Pharma, which is down about a couple of percentage points, or 3 percentage points if I'm not wrong. So Pharma is having a slightly tough day today. Reliance is not giving support after a very good rally last week. Reliance Industries is taking a bit of a breather. So some bit of profit booking out there, about a couple of percentage points lower for Reliance Industries too. At the broader end of the spectrum too, the market breadth is not too positive. We started off with about 1:3 in favor of the declines almost immediately within the first 30 minutes, and it stayed that way and worsened. Now the advanced decline ratio is worse off than 1:4 in favor of the decline. So the pain in the mid-cap index continues. Remember, last week the first 3 days were positive. The next two wiped down all the gains that we had at the mid-cap and the small-cap end, and that's continuing in today's session as well. A couple of percentage points off for the Nifty small-cap space. Pain for all the newsmakers. PC Jewelers down about 22%. Kesoram Industries, minor hiccups, but down in the session today. Hathway, Den Networks, etc. continue to grind lower. I think 7 or 8% or 9%. These are fresh lows for these stocks as well on fairly high volume. So you can see that the selling continues into these names which have the pressure points too. And not enough gainers. I think that's the problem point. There aren't enough buyers out there at the mid-cap end of the market, and which is why the pain points or the pressure points continue. 1% beverages is down about 5% as well the last time I checked. So the pressure points continue at the broader end of the spectrum. And save for IT, you can't find one pocket which is having a convincing move on the upside in the session today, despite the index just looking about 0.25% lower.
All right, Neeraj, thanks so much. That's the market check. Let's check on the macros as well. We got the wholesale price inflation numbers today, and you got an uptick in these numbers as expected, but perhaps a little bit more than what was being anticipated. I'm just reading some of the components, the headline number, of course, on your screens. But it's not just fuel and light which has added to the pressure on the wholesale price index. If you look at the breakup, you will see that non-food articles have also seen a sharp rise on a month-on-month basis of almost 3%. Within that, cotton is one component which has seen an 11% increase. Fuel and power, of course, is up 3%, but mineral oils is up 3.5%. The electricity group is up 4% as well. And manufactured groups, which is generally tracked to try and see, though the year-on-year numbers, month-on-month numbers tell you a bit more about how things are shaping up. But the manufactured products group has seen about a 0.4% increase. So I think the message in the WPI numbers is consistent with what you saw in the CPI numbers, that price pressures are on the rise. They are coming in from the input side also, but they equally coming in from demand-led inflation as the economy strengthens.
The other macro data, rising oil prices pushed India's trade deficit to $16.6 billion in June, the widest in 5 years. Overall imports rose 21.3%, $44.3 billion, while exports increased at a slower pace of 17.6% to come in at $27.7 billion. Petroleum imports surged by more than 50% over the same month last year. Rising oil prices took the energy bill higher. Machinery and coal imports also rose last month, with only gold jewelry and precious stones registering a decline. That's the fantastic trade deficit number for you. Let's take a closer look about talk about the trade balance with Saugata Bhattacharya, Chief Economist at Axis Bank. Saugata, many thanks for joining us today. What did you make of the spike in the trade deficit number? Was that in line with your own expectations?
No, this was higher than we had expected, than we had anticipated, and exactly as you said, I think the main source of the higher numbers, almost 2 billion higher than May, and up fairly 28% to YOY. So the proximate increase in the trade deficit, more than we had expected, came in essentially from the energy complex, not just petroleum, but also coal. So that was one of the sources. So in the petroleum side, petroleum imports have increased and petroleum exports have fallen. The fallen meaning, I mean, and even adjusted for the price increases, increase in the price of crude. So the proximate reason that I understand is that, for one, there are a couple of refineries that have not been operating at full capacity, which is likely to be offset in the next couple of months. So petroleum exports are likely to go up. But the bigger problem that I'm told is that domestic consumption of petroleum products, petrol, diesel, ATF, all the others, because of higher aviation growth. So as of now, it makes sense for many of the refining companies to focus more on the domestic markets than on exports. So that clearly is a cause of worry. And this despite the fact that petroleum prices, petroleum products of motor spirits, petrol, diesel, etc., have remained relatively high. So that's one reason, the strong domestic consumption of petroleum products, that needs to be addressed somehow. Other than that, as you said, gems and jewelry exports, I mean, that part is lower. But together with this, even in this particular month, in the month of June, even automobile exports, which shows up as the engineering exports, even that is relatively down. Hopefully that will stabilize over long-term averages going forward.
Saugata, what did you make of the non-oil, non-gold component? I think much is being talked about in the economist fraternity on what that is reflecting. Does that core balance also continue to worsen?
So there, I need to find out a little bit more in terms of the composition. So in petroleum, the ex-petro and precious stones, it's boosted by machinery. So that's one very high 33% increase in machinery imports, which might actually be good, which might actually signal some degree of demand for capital goods coming in from the country, whether it be from the highway side or whatever. But electronics, as usual, remains high. Almost 14% growth in electronics. And by electronics, it is generally understood that these are mobile imports and not so much in terms of television and other aids, but mobile and communication-related devices. So that's one thing that still remains relatively high. But there are others that which are more related to growth, say organic chemicals, coal we have already talked about, even metals, iron and steel imports. So that does seem to indicate, and particularly in the steel sector, we have been led to understand that domestic capacities are running pretty much near capacity. Domestic output is running pretty much near capacity. So that probably accounts for some part of the higher iron and steel and then other non-ferrous metals. So clearly that component of imports might be a signal for some demand-led capital good component, which is good. But having said that, I think a bigger worry is that exports are not picking up significantly. There has been a rise. Engineering goods has risen 14%, chemicals 30%, etc. But overall, the compositional part of the export might be a problem, and that might put some pressure on the current account deficit.
Okay, Saugata, just a last question from me. Staying with the import side, the gold import story, is that just a year-on-year comparison because last year was elevated and hence it's looking lower this year? Is there any reason to believe that there's a structural change in the demand for gold and hence gold imports?
I would think that there's been the reduction in the gems and precious stones and gold is also reflecting in somewhat muted demand. And this seems to be a break with our normal mentality in doing gold. And this is a global phenomenon. I mean, even with the overall risk globally, risk in the system, prices of gold have continued to come off. So that's a puzzle. But I mean, from what we believe in our internal trade, I mean, so the demand for gold and gems and jewelry is actually lower than what we have seen in the past.
I have one final question, Shagata. What does this mean for the rupee? Slowing inflows on one hand, this trade deficit number now. Directionally is the rupee going to be heading lower?
Directionally, I'm almost virtually certain. I mean, this is again, I mean, as we have talked about before, Harsha, the path to the grave to make currency forecasts. But I think there's a very, very high probability that the path of the rupee going forward, given the stresses on the current account and the ability of capital flows, particularly portfolio capital flows, to not meet that deficit anywhere close to what we have seen in 2017. I think it is virtually certain. There might be ups and downs. But the trajectory of the rupee is probably a depreciating one.
All right, Shagata, thanks so much for taking our call. Appreciate it. That's the trade deficit story and what it means for the currency markets as well. Flat on the Indian rupee today, in case you're wondering, about 68.68. Let's move on. A U.S. federal court has barred Dr. Reddy's from relaunching the generic version of a drug used to treat drug addiction. The New Jersey District Court has asked the drug maker to wait till a verdict is delivered in the patent infringement case surrounding the same drug. Darshan Mehta is here with the details. Darshan, DRL had a lot pinned on this drug, which is why the stock is reacting so badly.
Yes, you're right. But the other thing that happened was, if you see what happened with Dr. Reddy's in the last month, it did manage to rally around 17 to 18% on the expectation of this drug. What happened earlier this month? They got the US FDA nod for this drug, but they launched it at risk. Now, what does an at-risk launch mean? It means they've launched this drug at the risk of any kind of penalty, since the FDA has given the approval, but there were legal issues that were pending as far as the patent was concerned. So the patent was not over yet. So now what has happened? They have got a temporary restraining order. So they had 2 days in which they sold drugs. Then Endeavor got a temporary restraining order, and now that has been made into permanent till the time there is any kind of outcome to this litigation. What this means is that Dr. Reddy's cannot sell this drug till the time this litigation is over. Endeavor on his part has been made to sign a bond with an amount that will be decided later. So in case Endeavor loses, they will have to pay Dr. Reddy's that certain amount, and in case Dr. Reddy loses, it will have to pay 3 times the penalty of what it makes in this drug. Now, Endeavor has said that Dr. Reddy's in the 2 days probably has sold drugs worth almost $25 million, and that is why the stock price reaction was seen on the positive over the past few days. What does this mean for Dr. Reddy now? It's the worst case scenario that's playing out. A lot of analysts had estimated or put in their estimates Suboxone anywhere between 60 to 70 rupees was something that certain Nomura has put in. So that will be cut. The EPSR cuts will definitely come in, and a lot of other players who have approval for this, they will launch it. So the first mover advantage goes for Dr. Reddy's, and they will not be able to monetize this drug as much as they could have. Apart from it, a potential penalty also is the overhang on the counter.
Darshan, thank you for that. That's Dr. Reddy's for you. That stock has taken nearly a 9% drop in trade today. Over 10% indeed. Let's talk about technology now. The country's top 2 technology companies, Infosys and TCS, both have reported their quarter numbers. How do they tally against each other, particularly in crucial business metrics? Agam is standing by with some comparisons.
Well, we have the earnings of Infosys through now, and so which means we can compare how TCS has done in comparison to Infosys. So let's start and talk about the most important metric, that is revenue growth. And as you can see, TCS on a constant currency basis has seen 4.1% in comparison to Infosys at around 2.3%. TCS beat expectations, ahead of consensus. Infosys, on the other hand, in line. So in this case, TCS stands out with a score 1-0. Moving in, margins is the other important factor that can be used to judge how the earnings panned out. And while TCS did see a contraction of 40 basis points, the contraction for Infosys was a little more pronounced at 100 basis points, and it is also lower than TCS. So once again, this one falls in favor for TCS. When it comes to its most important vertical for both TCS and Infosys, about a good 31% of the revenues come from banking and financial services, and that is where, while TCS after the last 3 years, the management suggesting that we are in wait and watch mode, we are in wait and watch mode, we are in wait and watch mode. We finally starting to see a 3.7% growth for TCS, but that is not the case for Infosys, looking at a decline of around 0.2%. So worries still there for Infosys. TCS perhaps not as much. We're going to have to wait for a few more quarters for a trend to establish. And speaking of after the most important verticals, most important geography for TCS, as you can see, it's seen 3.7% growth in North America. About 51% of the revenues come from North America for TCS. Infosys, which has a higher share of as much as 60% coming in, has only seen a growth of around 2% on constant currency basis. And once again, this is where TCS wins, at least in the first quarter against Infosys, and that brings the score down to around 4-0. Finally, in terms of digital services, while TCS did see a higher growth on a year-on-year basis in comparison to Infosys, the contribution from digital services is nearly the same. So I'm going to put this one as a draw, but still at the end of it all, in terms of the other key variables, TCS certainly stands out in comparison to Infosys, and that's perhaps the reason why a lot of analysts out there also they have a slight preference to TCS in comparison to Infosys.
All right, Agam also covers the FMCG space, and the big number there to watch out for today will be HUL's earnings. Agam, what is the expectation there?
Sure. So we're expecting a very strong quarter for Hindustan Unilever. I'm going to start off with your revenues. We're expecting about 13.4% growth there. EBITDA margins likely to expand to around 23% against 21.9%. And similarly, consequently, we could see profits rise as much as 20%. Over the past 2 consecutive quarters, HUL has come out with a volumes growth of 11%, and that is what we're expecting this time around as well, with the range of 11 to 12%. The home care segment, which has done very well for HUL in the past, is likely to be, be pushed and further aided by the likes of brands such as Vim as well as Wheel. And of course, the personal care segment is likely to be pushed by premiumization carried out in Dove as well as Lux. We must remember that operational efficiencies, which have actually countered a lot of the other weakness in the margins, is something that will play out this time around as well. And on the whole, we're expecting another steady quarter from Hindustan Unilever.
Agam, thank you for that. Unilever numbers will be out later this evening. We'll keep a tab on it. Do log on to BloombergQuint.com. This week, we'll also see 2 large private lenders report their numbers, Kotak and HDFC Bank. Although these 2 are relatively buffered banks in general, they've been struggling to get their balance sheets in order given mounting bad loans. Shraddha is here to tell us if this quarter is likely to be any better. Shraddha.
Well, yes, Harsha, this quarter is likely to be better, at least as compared to the March-ended quarter, given that in the March-ended quarter, we had seen a huge amount of NPA recognition, which had happened, of course, driven by the RBI circular. So in this quarter, at least the core operating profitability trends are expected to remain healthy, given that we've seen a pickup in the loan growth. Even cost-to-income ratios have been improving, given the conscious efforts taken by banks to limit their OPEX. Stable asset quality and stable NIM should also aid this core profitability growth. However, that may not be the case for some of the PSU banks, which are seeing muted loan growth. Treasury losses, on the other hand, could weigh on the bank earnings. Yields on the benchmark paper have moved up by 50 basis points over the April to June period, while RBI has allowed amortizing MTM losses over a 4-quarter period even in June. But remember, banks have to account for a part of the earlier deferred MTM losses. This is for the banks who had used that RBI dispensation in the March and December quarters. The silver lining here is that you could see slippages come off, at least on a sequential basis. Once again, because large bad loan recognition was done in the previous quarter. And again, these slippages are expected to come just from the known sources, that is your watch list that was guided by some of the managements. Nevertheless, the provisioning is expected to remain higher as bad loan on account of bad loan aging, and has bad banks build in a higher provision cover. And you'll also have some banks who had used the dispensation with respect to the provision cover on NCLT accounts. They'll have to bring that back up to 50% in the June-ended quarter. That apart, we did see resolution of 2 large steel IBC cases, that is Bhushan Steel and Electro Steel. So that should help impairment ratios to some extent. So we could see some recoveries and upgrades. Largely, it's going to be the management commentary with respect to the overall, stressed resolution picture and any indication that stressed asset recognition has peaked out, that is something which will drive banks from there on.
All right, but are we still looking at some possible losses in Q1 for the PSU Bank, Shraddha?
Well, yes, Ira, in fact, most of the analysts believe, and even some of the credit rating agencies have mentioned that they're expecting to see a lot of PSU banks report a loss, not just for the first quarter, but the entire FY19. So among larger PSU banks of SBI and Bank of Baroda, which are expected to, report a decline in their bottom line for the quarter, PNB and Union Bank of India could continue to report losses. PNB, remember, reported a historic loss of 13,400 crores in the previous quarter. Axis Bank is expected to return to reporting a net profit in this quarter, and ICICI Bank could see a dip of about 30 to 40% in its bottom line numbers. Retail banks like HDFC Bank and Kotak Mahindra Bank, on the other hand, are expected to report strong earnings growth of 20 and 40% respectively. So once again in this quarter, we could see outperformance from retail banks as well.
All right, Shraddha, thank you so much for joining us. The Board of Life Insurance Corporation of India is meeting in New Delhi today to give an in-principle nod to the insurer buying a stake in IDBI Bank. The IRDAI, remember, has already approved the proposal with some riders. Nikunj, who's been tracking this meeting in Delhi, now joins us with the latest. Nikunj.
Currently, the LIC board meeting is underway, and what is on the agenda is the nature of investment of LIC in IDBI Bank. What would be the nature of investment, as in whether LIC would buy government stake in IDBI Bank, or there'll be a fresh equity issue by IDBI Bank. So what we do know now from our sources is that IDBI would do a preferential allotment of fresh shares to LIC, and the amount involved here would be around 10,000 to 13,000 crore, which LIC would infuse in IDBI Bank. Now, also on the agenda is what are the powers that board representatives of LIC would have on IDBI Bank, whether there will be any special powers given to representatives from LIC on IDBI board, since there will be a change in management after this transaction takes place. Over to you.
All right, thanks so much. We'll wait and see what actually comes out of that one. Let's move on. Legal hurdles are back to haunt JSPL. The company's chairman, Naveen Jindal, was one of the 15 people named in the Enforcement Directorate's charge sheet filed on Saturday. Bloomberg Quint's Nikki Mirchandani spoke with N.A. Ansari, CEO of JSPL, to find out about the financial impact of the mines in question if the investigative agency can prove its case in court, that is. Here's a slice of that conversation.
So, this is a very old case, and as you are aware, there were certain coal blocks which were allocated by the government based on the procedures which were followed at that point of time. And in 2014, based on a court decision, all the coal blocks which were allocated were deallocated. So, this case which is there is going on for many years. And actually, there has been no real, no issues at all as far as the company is concerned. Company has simply followed, the procedure has been followed by the government. We have simply been a party to that because the coal block was allocated. Obviously, we had made the application there. So we don't think that we have done anything wrong at all. And, that's what we have been explaining again and again and again. And we are absolutely sure that nothing is really going to come out of this case at all. Because, we have simply followed all the procedures which are there. The government followed the procedure. If there are any issues, by now something should have, there are many issues, many years from which this case is going on, and nothing really has come out of it so far. And these additional charges again are on the same way that it is, it is being done. There are different, ED has put some charge and CBI has put some charges, exactly on the same thing which were earlier. And we have already come up with the statement saying that there is really nothing in the case as far as we are concerned.
Sure, Mr. Ansari. I'd like to understand this abatement charges are over and above the one that has been filed in the charge sheet clearly. I'd like to understand, given the worst case scenario, what are the financial implications that we could be looking at if the charges were supposed to come out true?
You know, we have really, let me put it like this. We have not, the coal block was allocated, we have not used that coal block and it has been deallocated. So, you know, everything which is there, we have not made any use of the coal at all. So why should there be any financial implications at all? There should not be anything at all. It is, if there are some issues related to procedure, that will come out if there is anything at all. But according to us, there is really nothing irregular at all. So there is really no question of any financial implication coming out of this.
All right, sir. I'd also like to understand, given that the company, as per the IIAS report dated September 2013, it said that the company owns mining license for 9 coal blocks. I'd like to understand if there are any more coal blocks which are right now legally disputed, or there are any cases going on against these coal blocks right now, apart from the one that we've been talking about?
No, there are none. There is nothing else which is going on other than this case. There is no other active, case against us. So there is nothing other than that.
All right, that's JSPL for you. Slip in a short break. On the other side, Trump calls the European Union a foe of the United States ahead of his crucial meeting with President Putin. That's coming up on the other side.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you.
Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
You need a lot of patience into the next industry cycle.
Short-term pains for long-term gains.
Buying is complicated. Selling is 10 times more complicated.
If making money for investors were an art form, these folks would be maestros.
Statistically speaking, there is likely to be a big drawdown sometime in the next 6-12 months. Is it much more difficult getting stocks right now? I think that is the basic nature of investing.
Equity reflects the future earning potential.
Circle of competence, one of the most important concepts in investing.
Biggest risk that investor takes is when he pays the highest valuation at the highest margins.
Get in on a conversation on the art of investing with India's top portfolio managers on Alpha Moguls. Thursdays, only on Bloomberg Quint.
Welcome back. You're watching Power Lunch. Let's get to the headlines. Indian markets come off days lows but failed to make it into the green.
June wholesale prices come in at 4.5-year high. Petroleum products prices rise 8.1%.
France wins the FIFA World Cup for the second time, defeating Croatia by 4-2 in the finals.
And Djokovic wins his 4th Wimbledon title, overcoming South African Kevin Anderson in straight sets.
All right, after a weekend of sports action, back to the markets. Agam is here with us with a market check. Afternoon.
Good afternoon, Ira. Well, we are looking at a little bit of weakness, certainly on the Nifty, whereas the Sensex is largely flat at this point in time. And there's substantial weakness in the Nifty banking index, specifically in this case. If we can pull up the turnovers, when it comes to the cash markets, it's not too much to speak for, both on the NSE as well as the BSE cash markets. And it's the same for the NSE F&O turnovers, standing at just a little over 3.5 lakh crore rupees. What's really standing out in today's day of trade is on the gaining end, the tech stocks, and on the losing end is the pharma stocks. We do have Infosys up as much as 3%. This is, of course, after it posted earnings, which are largely in line with consensus expectations, but we have seen gains coming through for Infosys. And the other one, along with Tech Mahindra and Wipro, also pushing the IT index higher. On the losing end, however, we do have Dr. Reddy's taking quite a hit, and in fact down by as much as 9% at this point in time because of challenges arising in the US markets over a particular drug. Sun Pharma and Lupin not too far behind in weakness. They're also down and leading the pharma index, along with putting pressure on the indices too. And finally, Tata Steel is the other one, which is down by as much as 4.3%. Perhaps one of the biggest reasons why the Nifty metal index is also not doing well in today's job trade. But on the whole, otherwise, it has been quiet when it comes to the benchmarks.
All right, Agam, thanks so much for that.
Donald Trump rounded up the second leg of the EU tour by calling the European Union a foe of the United States. He says he considers the bloc a competitor of America and named it alongside Russia and China as potential enemies. Bloomberg's Anne-Marie Holden reports.
That's right. It's similar rhetoric we heard at NATO in Brussels. He came out hard attacking his European Union allies, specifically Germany. Then, of course, we had that Sun bombshell newspaper article before he went on to apologize to Miss May. In the press conference here speaking to CBS News when asked about his foes, Donald Trump named the European Union ahead of Russia and China. Let's take a listen.
I think the European Union is a foe, what they do to us in trade. And now you wouldn't think of the European Union, but they're a foe. Russia's a foe in certain respects. China's a foe economically, certainly. They're a foe. But that doesn't mean they're bad. It doesn't mean anything. It means that they're competitors.
Now, taking a line from Donald Trump's own playbook, the other Donald Tusk, the European Council president, tweeted, "America and the EU are best friends. Whoever says we are foes is spreading fake news." Tusk, by the way, is in Beijing right now for the European Union and China summit. He had another he had another comment to make about Trump, and this was about trade wars and saying that it can lead to hot conflicts.
Meanwhile, Trump is also slated to meet Vladimir Putin in Finland later today. Anne-Marie also lays out what's on the agenda for that meeting.
Expectations are very low. We even had the U.S. ambassador to Russia saying that this is not a summit, it's a meeting. So they keep, taking down the notch every time we speak to them about what exactly is going to be happening here. They're saying it's not a summit, it's a meeting. So expectations they are trying to lower, and a lot of this probably has to do with those indictments of those Russian Russian intelligence officers. And this goes back to the election meddling when Donald Trump was, of course, elected president. Now, Donald Trump is under a lot of pressure from the United States Congress, including members of his own party. The Democrats are saying, though, that the summit should be canceled completely in protest. That's not going to happen. Trump says he will ask about election meddling. He even says he may ask for the extradition of these intelligence officers. But of course, in Russia, that would be going against the Constitution. They do not allow citizens to be extradited out for trial abroad. So that's going to be a no from Putin, but he says he will bring it up. Also on the agenda, what we'll be looking out for here in front of the presidential palace is when they talk about nuclear proliferation, Syria in terms of Iran, Ukraine in terms of Crimea, and potentially oil.
Anne-Marie Holden reporting from Helsinki. Trade tensions with the United States failed to hamper China's economic expansion, although GDP grew at a slower pace in the second quarter. Bloomberg's Tom McKinsey reports from Beijing on the big takeaways.
There's no sense of panic from this data, at least for China's policymakers, but equally no room for complacency. So the second quarter GDP print, we don't want to invest too much time in analysing that given the statistical issues here in China. But that came in at 6.7%, marginally below the 6.8% we got in the first quarter. The government's target is 6.5%. Really, the juicy stuff is around those industrial output numbers, as you say. Industrial output was a miss. That was a disappointment, 6% versus 6.5%. Retail sales, though, a bit of optimism there, coming in better than expected, up about 9%. That was on the back of some pretty weak numbers in May, so suggesting that the strength, the optimism, the Chinese consumer is holding up. And then you've got fixed asset investment that came in line with the surveys that we were seeing. Of course, the two key challenges that China's policymakers face at the current stage is the trade war, of course, the trade tensions, and then, of course, the deleveraging campaign. So how they square those two issues. We're starting to see now, from Bloomberg Economics at least, their analysis is that you're starting to see a tilt towards a pro-easing bias from policymakers here. And it was interesting to hear from JP Morgan's chief China economist, Grace Ng, speaking earlier. She was saying the exports actually were pretty constructive in the first half for China's economy, but they're likely to slow as a result of these trade tensions. That could prove something of a drag in the second half. Most economists, the consensus is still that you're going to get around 6.5% in the second half of this year.
All right, bringing the conversation back to India, Samir Arora of Helios Capital is placing his bets on large cap stocks. Speaking to Neeraj Shah earlier today, he said that Indian equities will continue to be driven by a few high quality stocks. Here's a slice of that conversation.
Mid caps are getting a correction and maybe 10 or 15 stocks are holding up the market. And because we have been multi-cap all our life, relatively this environment is a little bit better for us than an environment where only the small cap stocks go up a lot, relatively. In absolute, obviously, last year was much better. But in general, I would think that we overdid it last year. And now I still think they're not overdoing it on the mid cap, small caps. They may correct a little bit more, but the market overall is very tough and our system is not helping.
Could you explain that? I mean, are you talking about whatever, the regulatory measures or otherwise, or what is it that you think is not quite helping?
The ease of doing business has deteriorated in terms of fund management industry. You must have seen today's paper saying that we are targeting NRIs because they do round tripping. Imagine a poor fellow who's trying to do round tripping, who has money outside India in dollar terms, which he has effectively taken away from India, and he wants to put it back into this market. What is his thinking? So the idea that, that India is such a hot market, that people who have by fraud or cheating or whatever taken out money, their first plan is to bring it back into India. Right now, I mean, talking the last 1 or 2, 3 years. There's nothing happening for a guy who has stolen money out of India to first think that he should put it back into India. So these kind of fears, these kind of, phobia or whatever, oh my God, somebody's coming back with his money into India and God knows what money he's making in India. These kind of things are, and then taxes, and then KYC, and then everything, then ban P-notes, then ban P-note shorting, then now don't go into Singapore, as if somebody's taking advantage of India. Nobody's taking advantage of India, but we are discouraging any normal fellow unless he's totally committed to India. We are totally committed because that is the only thing we do. But the world does not have so much time, I think.
You reckon that's probably one pain point going ahead as well on a relative basis versus other EMs or Asia dedicated markets? We're kind of losing out. Do investors speak about this quite frequently now?
Everybody. The only difference is they don't come on TV and say it, and because I love India too much, I say it so that powers can get feedback. Because otherwise, you see, the problem in our system is that these guys don't give feedback. And if they don't give feedback, the system thinks that they are doing a good job. Everybody is a bit upset. And the thing is, India dedicated guys will still handle it because of lack of, for the fact that they are doing an India dedicated business like we are. But otherwise, you think anybody has time? Of course. On the other hand, if the market was going up 30% every year or this year, then people will say, I don't care, we are making so much money that these are part. But if suppose, like it is today, and generally it is, that the markets are not going anywhere and then you have to do these 50 more things. Look at it, one more thing. India is the only country where the fund pays a tax and not the individual. So let us say the return of the investor is 15% per annum and we have to pay 10% tax, broadly speaking, long-term capital gains, let's say. So the fund's returns are reduced by 1.5%. Now, how does this fund ever beat an index? Because normally funds can't beat an index normally. Now you're first reducing 10% from the return and then you have to beat the index. In other markets, even if there's a tax, the investor pays that tax, not the fund. And therefore, the fund can say, I outperform the market, like say Indian PMS scheme. They can say, we outperform the market. Now you go and pay your tax. In India, only country in the world where the fund has to pay the tax. And there is no way of differentiating that to saying, no, this is a pre-tax NAV or a post-tax NAV. So even last week, one of the big four accounting firms called us to say that, how are you calculating? We said, I've been asking you for 2 years, now you're asking me this. So these are things which, again, India dedicated fund will say, okay, there is that, but who has the time? Who else has the time?
All right, that's Samir Arora. Meantime, the big story that we were awaiting seems to be flashing across our screens. The LIC board, which was meeting in Delhi today, has indeed approved picking up 51% stake in IDBI. That is exactly what they had gotten approval from the IRDA for, that they would be allowed to go well above that 15% cutoff and go as high as 51%. That is the headline, but the real story lies in how that 51% stake is being accumulated. Is it a fresh issue of shares, in which case the capital goes to IDBI Bank, or is there also some stake transfer from the government to LIC? What has been talked about most likely is that there will be a fresh issue of shares. There will be hence a dilution of the government stake. LIC stake goes up. Should LIC be asked to make an open offer for IDBI, perhaps the government will not participate in that open offer, which will further bring down the government stake. But all of those details are awaited. As of now, what we know is that the second step in this process has come through. The first step was to get the IRDA on board. The IRDA had to allow LIC to do that. Now that that was done, it was up to the LIC board to approve it. Now with LIC board approving it, this proposal will go to the IDBI Bank board, and the IDBI Bank board will also have to approve it, which should not be a problem because this looks like something that has sort of been orchestrated with the government's approval and all parties coming on board. Nikunj is joining us online. He's the one who's breaking this story. Nikunj, what have you picked up?
According to the government representative on the LIC board, Mr. Subhash Chandra Garg, LIC has approved buying 51% stake in IDBI Bank, and there will be an as we had reported that firstly there'll be a preferential allotment of shares by IDBI Bank, and then there'll be an open offer. So what he said, government would not sell its stake in IDBI Bank as of now, and the proceeds from this entire transaction will go as capital infusion into IDBI Bank. He has not confirmed the amount. He said a formula would be worked out, and then the amount would be finalized.
Nikunj, hold that thought. What you're saying is interesting. You're saying this is going to be a preferential allotment where the government is not going to be diluting its stake. Can you explain a little more in detail? And do we know any numbers off the cuff, or does it in line with the numbers that we were talking about last week?
So firstly, there'll be a preferential allotment of shares. If you remember, the government holds around 11% in IDBI Bank, so it can acquire up to 25% in IDBI Bank, and only then there'll be a need to trigger an open offer. So firstly, there'll be a preferential allotment of shares so that LIC can acquire up to 25% stake in IDBI Bank, and after its holding crosses 25%, there'll be a need to trigger an open offer. That is how the rest of the stake, that is how LIC would eventually hold 51% in IDBI Bank.
Okay.
Nikunj, stay with us on the line. I believe we have the sound bites from the DEA secretary. We'll try and get them in. I didn't quite understand that structure that was being detailed over there. So perhaps we'll get a little bit more detail. Nikunj, if you're still with us on the line, can you again repeat what exactly the process is going to be in getting this 51% stake in IDBI Bank, the step-by-step?
So firstly, there'll be a preferential allotment of shares where LIC would acquire up to 25% stake in IDBI Bank, and per regulatory requirements, if a company is if there's a change in management, if there's a change in majority shareholder and the stake of that shareholder increases over 26%, there's a need to trigger an open offer. So there'll be a chance that the government would also get to divest its holdings in IDBI Bank when there's an open offer, but that's something that we'll get to know later. But that's how the entire process would be. Firstly, there'll be a preferential allotment of share, and then there'll be an open offer so that LIC would increase its stake from current 10 or 11% to 51%.
Okay, Nikunj, we'll let you go on that note and perhaps get a bit more detail on what you're saying. But he seems to be suggesting that there will be some, government stake transfer from IDBI to LIC as well. At least that's what he seemed to be alluding to. I think the debate was whether the government gets the money or IDBI gets the money. And if what he's saying is, suggesting that there are two parts to the deal, then maybe there will be some capital infusion directly into IDBI Bank and also some money that will go into the government's coffers, perhaps.
Correct. That's exactly what he's trying to say. Well, let's wait for the details before we sort of, get on some more details on this one. If we have, we don't have the sound bites of Subhash Garg as yet, but if you've just tuned in, here's the story. The board of Life Insurance Corporation of India has approved buying 51% stake in IDBI Bank. That means LIC will be hiking its stake from the current 10 odd or 10.82% to 51%. It is not yet clear how much capital will be used to increase the stake. IDBI Bank will, we are told, make a preferential issue to LIC. And the second step will be LIC buying the stake. Let's in fact listen into what the DA secretary had to say.
51% shareholding in the IDBI Bank. They already have about 7.5%. So remaining they will acquire from the government.
So in one shot?
In one shot, most probably. Otherwise, the objective of getting 51%
should. And through preference shares? I mean, IDBI Bank will be issuing the preference shares?
Most likely that would be the way. The IDBI Bank needs capital, so they would issue a preferential share. That should be the most one. The other one is that they can buy from the government, but that doesn't provide capital to IDBI Bank, and therefore that's the preferable mode to do it, right?
So the money will go to the bank, sir. The money will go to the bank. LIC's money will go to the bank.
Of course, yes. That is what the new issue.
So what is that quantum?
Sorry?
Sell some shares in the open offer?
No, open offer itself may or may not come about because public shareholding is very small.
Right.
It's only about 5%, right? And the pricing formula, etc., may not be very attractive, but they will go through that process. If necessary, they will make the open offer, but it's not very material issue in this context.
Right.
That's why.
So what is the amount that we're looking at, sir? What is the transaction size we are looking at, sir, tentatively?
What is the amount of?
Sir, the amount that...
No amount need to be worked out right now. This would be as per the formula for the preferential shares which are issued. Right?
And so how can we go?
Time frame now. They go to the board and also seek the due approvals.
So will clarity by September?
The approval of the government would be definitely required.
So
Subhash Garg, the DEA secretary, explaining, saying that the money will directly go to IDBI Bank, which means they're going to be offering, it's going to be a preferential allotment to LIC. LIC's stake will increase from about 10.82% to 51%. The government is not going to be directly involved. I've got Hemendra Hazari on the phone line. Hemendra, pleasure as always. What have you made of the structuring of this deal? There's been enough debate about this. What have you made of whatever little information we've received so far?
So this is the way it had to have been done. Otherwise, IDBI desperately needed capital because of its NPA position. The government, because of fiscal deficit reasons, very foolishly has not decided to pump in capital itself. And therefore, now we have LIC, which is operating like a de facto sovereign here. And LIC, policy holders are effectively bankrolling IDBI Bank.
Mr. Hazari, what is your own estimate of the amount of capital that IDBI Bank may need, just going by their balance sheet as it's been disclosed so far? I think the numbers are well in excess of the 10,000 crore which it got from the government last year is what we pick up.
Obviously now, because depending on how the NPA situation is, and given the fact that a lot of these big tickets are going to NCLT, where they are huge, gigantic, really discounts, which are very close actually to liquidation value, there are going to be growing demands of capital. And an ever-obliging LIC will see to it that the policyholders' money gets channeled there. So that is what is going to happen. Because today everyone is underestimating retail NPAs. Nobody wants to talk about it at all. But that's where the next round of NPAs is really going to come from once all these corporate NPAs have surfaced.
Okay. We also have Mr. D.K. Mittal, the former Financial Services Secretary, joining us on the phone line. Mr. Mittal, what have you made of the structuring of this deal? Does this help the case of IDBI Bank, meet its capital requirements, and what's LIC's skin in the game here?
See, my personal view would be that approval of 51% by LIC board is not very important step unless we know the full strategy. What is behind this? If they want to retain the bank, then it is a bad deal. If they want to be a wire media for disposing it off and bringing a private partner, then it's a good way to do it. In that way, LIC can make a lot of money. Otherwise, it is going to be a bad thing. LIC cannot manage a bank. They have no capability whatsoever to do that work. They have been an investor, so that's what they do. But holding 51% means that you are really owning the entity for all practical purposes. Neither they have competence nor bandwidth to do that.
Mr. Mittal, this deal, good afternoon, this is Ira joining in. This deal has just too many questions that it's raising. Question number one is that why is the government not putting this capital in? I know everybody is explaining it away by saying that government has its own fiscal pressures, but these are government banks. They are responsible for them. They have to put the money in. Why is this onus being transferred onto LIC, sir?
See, that's why I think if the strategy of the government is that rather than we doing this investment, which is a complicated process in the government, we are asking LIC to bring in money and then do this investment is the right strategy. I fully support that strategy being in the government. I understand the limitations which come through in the government when you are trying to disinvest anything. But this is the right strategy. That is the objective. But if that is not the objective, then this is a very bad deal. And I agree with Mr. Hazari. He was saying you can't put policyholders' money there. There's no way.
No, but sir, I mean, even if that is the strategy that you first give it to LIC, 51% to LIC, and then LIC sells down the line to potentially a private investor, then on both sides, the government is sort of abdicating its responsibility, first to put capital, and two, if there is a successful disinvestment, you could then turn around and question why the taxpayers didn't get that money. Because it is the taxpayers' money which has gone into IDBI Bank all this time.
No, that's not fair. One, if government was to put in money, it will remain a public sector as it is today, and they will have to disinvest. Secondly, LIC disinvest and they get a better price on this. The government holding will also get, they hold 40%, today they hold about 70% today. So they still have a lot of holding. And, even if they're diluted after LIC puts in more money, they still have a lot of money to be made out of the equity which they're holding. So I do not think government is going to lose it at all in this whole process.
Mr. Hazari, you want to come in on this? If the strategy was for LIC to just play the role of holding the stake for a brief period before it sells off to a private company, does that argument hold merit?
Yeah, I agree with Ira here that when you are the majority holder as the government, why do you want to give it to LIC? Because the whole purpose of them selling it down later is that there will be hopefully more value added. So therefore, the national exchequer should get the upside. Why should then LIC people get the upside? And the central problem which nobody really wants to question is why cannot the government increase its fiscal deficit and do its responsibilities as a majority owner? This is really the critical question, why you are doing this convoluted structure and getting LIC policy holders at risk. Government is the majority shareholder. It is government's duty to pump in the capital. And if the fiscal deficit has to increase, so be it. The fiscal deficit is there for the people of this country. It is not there just to, for foreign investors to, show apprehension. And anytime the fiscal deficit increases, this whole war cry goes up that, inflation will rise, yields will go up, foreign investors will pull out. The fiscal deficit is to better the citizens of this country. It is not there to see that foreign investors get a good deal.
Mr. Hazari, can I bring in another aspect of this story, and which is, LIC's interplay with the banking sector? In the past, I know that the Reserve Bank of India has not been very keen for LIC to make a direct entry into banking. When they did the private bank licenses, they said it's private, so they did not consider LIC housing finance license. But there are other interlinkages. LIC has more than 10% stake in at least 7 or 8 banks, if I'm not wrong. LIC has its own loan book. LIC has NCDs, which it is sitting on. The financial stability risks that could emerge from LIC's interplay with the banking sector, are those worth focusing on, sir?
So most definitely, because here you see LIC's investment now in IDBI Bank is different from the way it's investment in other PSU banks. Here you're taking majority control. In fact, in my view, the RBI should not have allowed for such a transaction to have taken place. When they've refused LIC earlier, LIC housing to give a banking license, how can they now agree to IDBI, taking a majority stake in IDBI? See, this is the whole issue. Under this present governor and RBI, it doesn't seem to have any autonomy, and RBI's credibility keeps, hitting a new low every day. And we've seen this in demonetization, the way how quiet it has been in the ICICI Bank matter. And here also doesn't seem to have any voice to utter when, the government very coolly abdicates its responsibility as an owner and passes it on to LIC.
All right, Mr. Hazari, we'll let it go. Thanks for those initial thoughts. I think as we get, fine print of this deal, we will have to analyze a little bit more detail. I just, want to once again just repeat the basic structure of what has happened so far. We've had the IRDA say that they will allow LIC to increase their stake in IDBI to 51%. Under existing rules, they're not allowed to actually hold more than 15% of an individual company's entity. So that one rule has been already eased up. Now, the second stage was to have LIC approve the investment. LIC has approved the investment. The board has said that they can take their stake up to 51%. What Mr. Garg, that's the Department of Economic Affairs Secretary, was telling reporters seemed to suggest that there could be two parts to the deal, where there is a preferential issue and then, perhaps some amount of stake gets transferred from the government to LIC as well. But to be fair, we don't know the exact mechanics of it. But that mechanic will be important in understanding how much money actually goes into IDBI Bank. Remember, whatever anybody else is calling this, Harsha, this is a bailout of IDBI Bank. There is just no two ways about it. So it's all important to understand how much capital actually goes into IDBI Bank. They have NPAs which are 27%. In fact, ICRA had come out with a note saying that the actual stressed assets on their books are more than 30%. So they need capital quite urgently. They need capital this quarter. They need capital next quarter. So the money that comes in from LIC into IDBI Bank is going to be all important. From here on, the approvals that will be needed will be the IDBI Bank approval and also an RBI approval, which I'll get to in a minute. But I believe Mr. J.N. Gupta is with us on the phone line. Mr. Gupta, thanks for taking our call, sir. This is Ira from the Bombay studios. So what do you make of this? It looks like it's a preferential allotment, so it does seem like the money will go to IDBI Bank. But, the questions on why LIC should be doing this still remain.
See, again, I would say that we should view this deal not as a between two public sector units, but as a business decision. If it was between two private companies or anything, we would have raised only one question, whether the deal is in favor of the shareholder or whether the deal is done at the instance of a controlling shareholder. Now, in this case, if the deal is being done purely at the call of Government of India, and not because the LIC feels it is a good investment, then it is a questionable issue. But if LIC feels that it is a good decision, it is in the interest of the shareholder, then I do not find anything wrong. The only thing is that the government has very limited ability, unlike the private sector people, and their structuring is always faulty. Any private sector investment bank has structured their deal in such a manner that the question would not have been raised. But that is what will always be a problem between the government company and private sector company. But I would say if it is only at the expense of a shareholder, it is bad. But if it is in the interest of investors and LIC Investment Committee has evaluated this, then there is nothing wrong with it.
So Gupta, there is a view that says that the LIC perhaps is taking this position perhaps to sell to a private investor later in the day and sees it as an interesting investment opportunity. Do you think there is merit in that argument when policyholders' money is used to fund this or fund this stake hike?
No. Please understand. You are contradicting yourself. When you say that LIC is thinking of putting their money now and farming off later in a day to some investor at a profit, then this is precisely what is the LIC's business. You should make investment and realize for the policyholders. So if they are going to do this, they have recorded it in their investment committee, this is what their intention is, then I do not find there is anything wrong with this. But the only question is whether this deal is being done at the instance of government only or LIC board feels that this is in the interest of LIC.
Sir, I mean, again, we are waiting for the details, but, I think the question on the open offer is also out there, whether an open offer gets made or not. Very small public shareholding, to be honest.
As far as my opinion is concerned, since it is an issue of preferential offer, the shares through the preferential offer, open offer gets triggered, it is not like the ONGC and HPCL.
Okay, Mr. Gupta, thanks so much. I think we'll wrap up with this, but I do want to just very quickly make one point with ICRA had made in a note just about a week or so back on how they see the structure. I mean, it's important to see how rating agencies see the structure, and they're the only ones who have a view out there. Harsha, they said that if LIC is sort of becoming the backer, the main promoter, LIC has the same amount of capital, wherewithal that the government has. So the capital support that is assumed into IDBI's ratings will not change. So, they're okay on that front. But if you assume that LIC is coming in only as an interim investor and eventually intends to sell it down to some other investor, then should you assume that level of capital support or not? Because it's an interim arrangement. They are not the promoters. So should you get that AAA backing of LIC, and should IDBI Bank get that benefit of having a AAA parent or not? If they're not a parent, then should that benefit actually accrue to them? I think some of those questions will remain. We're probably out of time on the show.
We'll wait and watch some more details on how this story is going to play out, how much capital is going to be invested, and more importantly, the crucial question of whether there will be an open offer or not. Let's wait and watch. If you have been, thank you so much for watching.